Paul, to you on this one. Sometimes those high-yielding rental properties can actually be quite risky, can't they? Because they can be in mining areas or places where the jobs are temporary, and that's why you can get high returns on them?
Yeah, absolutely. I think that's the key point here with cash flow. I think Michael's raised some good points, is the fact that if people are chasing replacing their income through essentially buying a property that's got a high yield from the outset and still getting an 80% loan to value ratio on that property, the likely outcome is that they're probably going to break even at best. Then after you've got a few years of good, bad and different outcomes, you're essentially not really going to be earning any money. So you need to have the mindset that property, especially in the early foundation stages, is for capital growth. The cash flow will keep you in the game. Now, some of the mitigating aspects we look at are most certainly vacancy rates. Vacancy rates are going to be your friend, and not necessarily just looking at top line vacancy rates, understanding the underlying aspects of where the demand is, what property types are most in demand for renters, because vacancy rates don't just assure you, or low vacancy rates rather, don't just assure you of good quality tenants that are going to essentially be in your property for the majority of the year, but they also mean that there's probably going to be more demand, and that in turn means you're probably going to have more choice. And choice is key when it comes down to selecting quality tenants. Now, whether that's in a secondary market or a prime inner city market, more choice means you're going to be able to select someone who you think is going to be deemed, or at least your property manager is going to give you advice to who you deem to be the best tenant. So they're probably some of the things that I personally would consider.
All right.